In the last video, we have reviewed the early history of investment banks, and we have learned that prior to the Great Depression, the investment banking industry of the US is characterized with strong demand for securities, mixture of investment banking and commercial banking, and lack of federal regulation for the industry. In this video, we will move on to the industry regulations since the Great Depression. After the Great Depression, President Herbert Hoover did not promote any meaningful new regulation of the financial market. When Franklin Roosevelt took office in year 1933, the U.S. Congress passed 7 pieces of legislation that significantly impacted the business of investment banks. These laws drastically altered the business environment of investment banking and still influence the industry today. In this lecture, we will be focusing on the 3 pieces of laws launched after the Great Depression, including Securities Act of 1933, Glass-Steagall Act of 1933, and the Securities Act of 1934. First, let's look at Securities Act of 1933. This act has 2 main purposes. The first one is to regulate disclosure in security issuance. Prior to 1933, few investors received basic information regarding their investments in securities. Securities Act of 1933 requires companies and investment banks to disclose financial information and other significant information concerning the securities being offered to the general public. The second purpose is to prohibit deceit, misrepresentation, and other fraud in the sale of securities. The Securities Act of 1933 has 4 main sections that directly impact the underwriting business of investment banks. The first one is registration statement. Before a security can be sold in the United States, a registration statement must be submitted to the Securities and Exchange Commission, known as SEC. Registration statement contains financial statements certified by independent accountants, description of securities to be offered for sale, as well as information about the management of the issue. A registration statement might be revised many times until SEC approves. Along with providing information to the SEC, companies are also required to provide information to the general public. Companies disclose information to its potential investors through a prospectus. A prospectus contains information similar to what is included in a registration statement. To ensure the effectiveness of information disclosure, this Act introduces civil and criminal liabilities for disclosure. Violation of disclosure requirements can lead to criminal offense for underwriters, directors, officers, and accountants. For example, investors can sue a company and its underwriters if material facts are omitted from the registration statement and investors suffer a loss that is attributable to that omission. In case the price of a stock fell below its issuing price, investors can sue the underwriters to purchase the stocks at the original price. Issuers and investment banks now share responsibility to provide accurate and complete information to investors. In order to avoid being held liable for false or misleading disclosure in a registration statement, an underwriter must conduct a due diligence investigation about an issuer in an effort to mitigate risk. Despite due diligence effort, it is still likely that an issuer is hiding information to its investment bank. Investment banks usually try to protect themselves by signing an indemnification letter with the issuer. An indemnification letter serves to protect the banks for losses arising from material misstatements or omissions from that issuer. As we have talked earlier, a registration statement might be revised many times until SEC approves. Issuers file a preliminary prospectus at the time of registration. The preliminary prospectus is called a red herring prospectus and will be revised until SEC declares the registration statement effective. The term awaiting period or cooling period refers to the period between the filing of a red herring registration statement and the approval of the registration statement. During the quiet period, sales of securities cannot be made. Firms are also not allowed to disclose additional information other than prospectus. The waiting period requirement prohibits information disclosures unregulated by SEC. Violations of the waiting period are referred to as gun jumping, and their IPO calendar may be postponed. The last law shaping the banking industry is the Glass-Steagall Act of 1933. As we have discussed in our last video, the crisis from the stock market spread to commercial banks and affecting the lives of nearly every individual because there were loose separation between investment banking and commercial banking. The banking system in the United States had effectively stopped functioning in year 1933, and over 11,000 banks closed or merged during the Great Depression. Glass-Steagall Act of 1933 aimed to separate commercial and investment banks. This act also created the Federal Deposit Insurance Corporation, FDIC. After the launch of Glass-Steagall Act, commercial banks were only allowed to underwrite bonds for municipal, state, and federal government. This act also mandates the separation of directors and officers from commercial banks and security firms. In year 1999, the Glass-Steagall Act was overturned by the Gramm-Leach-Bliley Act, which is also known as Financial Service Modernization Act. The Act of 1999 allows a U.S. bank to operate both commercial and investment bank business. The last piece of law we will be covering today is the Security Act of 1934. This act deals primarily with security transactions on the secondary market, i.e., transactions after stock issuance. The main purpose is in line with Securities Act of 1933 and is about ensuring greater financial transparency and accuracy and less fraud or manipulation. This act introduced ongoing reporting requirements for listed companies. Listed firms must file annual and other periodic reports that need to be available to the public. Significant corporate events are subject to filing requirements as well. An example of significant corporate events is the acquisition of significant ownership stakes. Significant here means more than 5% of shares outstanding. The Act of year 1934 also created the SEC, which took over the responsibility of supervising the capital market participants, including public companies investment banks, and exchanges, broker and dealers, and traders. Insider trading is also prohibited by this act. Insider trading means trading with information not disclosed to the general public. Okay, in this video, we have discussed 3 pieces of laws launched after the Great Depression. Thanks for watching, and in the next video, we will talk more about the recent developments in market regulations.